In 1980, gold hit what was then a historic high. Inflation was out of control. Oil prices were spiking. The Soviet Union had just invaded Afghanistan. Investors were gripped by fear, and gold felt like the only safe and steady place to be. For a moment, it looked like a brilliant move, the kind you mention at a barbecue to feel like the smartest guy holding a beer. Then, in just 2 months, gold lost more than 40% of its value. Within a year, it was down nearly 65%, and it didn't recover that peak for another 27 years. So right off the bat, they're painting gold in a very ugly light. They're making it sound as bad as possible. So you want to jump in, Mike?
Well, they picked,
pick the high.
He should have actually said pick the date of the actual high. January 1980. He didn't put in January there. If you can do this with anything that goes through cycles. You pick the previous high, and then it takes years. I think we did in the book an inflation-adjusted S&P 500, and the crash of the NASDAQ. I mean, the NASDAQ took a long time, but even the S&P took more than 13 years to get back to its high. This is 27 years, and we are coming off of historic lows. Now, gold went up from 35 to 200, and then did a pullback to 103. The first day of 1975, for the next 14 or 16 months, it fell, 16 months, I believe, to 103. So if you had bought in there, you would still look brilliant because you were in profit the whole time, even if you didn't buy at 35. If you bought at 150, at 180, at 190, you were brilliant, and you're still brilliant even with that. But the thing is, everything goes from overvalued to undervalued to overvalued to undervalued. And they picked what had been the most overvalued time in history to start this measurement.